now about 3 or 4 years ago, which started as an Excel sheet, but now has since morphed into something else.
Welcome to the Freedom Point Real Estate Podcast, where we talk about creating more time freedom through passive real estate investing. Passive investing in real estate challenges conventional investment wisdom. We are passionate about learning and sharing resources with others who are ready to transform their investing mindset. Quick disclaimer as always, I am not a CPA, I am not an attorney or a financial advisor. This is not financial advice, not telling you or anyone else what to do. The views and opinions expressed in these podcasts are provided for education and informational purposes only and are not necessarily the views of my employer. I'm glad you're here. Now let's dig in. All right, welcome back, Freedom Point Podcast listeners. Thank you again for jumping into another episode of the Freedom Point. We're so glad you're here with us again today. I've got an amazing guest, Dr. Samuel Giordano. Samuel, welcome to the show.
Jeremy, thanks so much for having me. I've been looking forward to this. I appreciate you taking the time.
Yeah, I'm looking forward to chopping it up with you as well. Dr. Samuel is a practicing gastroenterologist, author, real estate investor, and co-founder of PassiveAdvantage.com, a website designed to help physicians and other high-income professionals vet passive real estate syndication deals. Dr. Samuel, I can't think of a better resource for passive investors than PassiveAdvantage.com. Why do I say that? Well, because as a limited partner myself in 37 deals with multiple different sponsors, I can assure you that my mailbox fills up every single week with the next new deal, right? So maybe you can kind of help us understand a little bit more about, Dr. Samuel, what you're focused on today, your journey, and really dive into the specifics of how PassiveAdvantage.com helps investors.
Yeah, no, I really appreciate the opportunity and thanks for having me on. So I mean, I kind of fell into the space a little bit. I mean, I'm now going on. It's crazy to say it, but probably 13 years out from fellowship training as a doc, and as a doc, you get kind of early on, you're knee deep in student loans and other things, and I followed White Coat Investor, who is sort of a physician, personal finance guru, and that really led me to kind of form the foundation for my financial sort of house in order early on with maxing out my retirement accounts, saving for my kids' 529s, contributing to what the backdoor Roth, or sort of when your income doesn't allow you to qualify. And then thankfully paying off the student loans within the first 5 years. I kind of just went head on to get those paid off. So, once I reached that time and was doing all that stuff, and I'm like, all right, well, what's next? What do I do next? And sort of, I was even maxing out some of the, putting some money into our taxable accounts as well. And then I stumbled across real estate, and I actually dabbled for a bit about, whether or not I wanted to invest actively and buy a quadplex. And I got pretty deep into the process and started to talk to people that I respected and that had been doing that. And I was just like, you know what? I have a full-time day job. I like what I do. I'm not looking to change it, but I don't know that I want to take on another job. And I came across real estate syndications back in 2017. And, it's a little daunting. And this is part of the reason of the advent of Passive Advantage. Is I remember early on, I'm like, man, this is like a whole nother world. Like, what's going on with this? Is there something shady? Like, is this real? And it took me a while to kind of like dedicate myself to building up my knowledge base and really grasp sort of the nuances of syndications. And during that first year that I was kind of learning, I would write down everything I could or that I came across that I thought was important to look at as a limited partner. And during that process, I formed an Excel sheet that allowed me to form like a checklist. And then I'm pretty active in these other sort of real estate groups and real estate forums for passive investors. And I was mentioning that checklist, and that's when other passive investors reached out to me and asked me about the sort of, if I could share it with them. And there was one day I received like maybe 100 private messages to share that checklist. And I'm like, you know what, let me let me sort of see if I can edify this and run it by some people who I respect with Excel and things like that. And then that started Passive Advantage now about 3 or 4 years ago, which started as an Excel sheet, but now has since morphed into something else.
That's great. Well, before we jump into it, I have to ask you the question: are you attending White Coat Investors Conference in a week and a half?
So yeah, this is another one that I was planning to do, and I have this. It just so coincidentally, I have like a crazy work meeting that is our own conference that I'm supposed to be speaking at myself. So I'm trying to work the schedule around so that I can go there and see Jim. I'm close with Jim. We communicate with each other all the time. But yeah, so I'm doing what I can to try to make it happen.
Sounds good. Well, if you're able to make it happen, let's connect when we're there. Would love to get your perspective on something, and that is, what would you say are some of the biggest mistakes you see, physicians and other professionals making when they're evaluating syndication deals?
Yeah, and it's, if you would have asked me that question maybe like 3 years ago, the answer would have been different than what it is today. Um, I think in general, I feel like, and I'm speaking mostly for physicians. I work at a hospital that has probably 700 other physicians, so we're a pretty big hospital system. And I speak to other physicians and sort of talk to them about syndication investing all the time. And I think one of the fundamental things that I feel like people who invest in these type of things, they don't take the due diligence seriously enough early on. And not that, listen, you could do all the due diligence you want, and not that it's gonna like, there's innate risk. Like, this is not just like investing in the stock market where there's still risk, but it's not as if this is sort of a private placement and there's different sort of risks involved. And that's why, from a regulatory standpoint, you need to make a certain amount of money or have a certain amount of net worth. But I do feel like early on there were a lot of physicians and other professionals that were, saying, I like this guy and I'm just going to invest, and not looking at any of the dynamics and the vetting parameters and like what you can look at in terms of what to look for in a sponsor or the deal or the debt structure. So early on, I think the big thing was that people didn't take the vetting part seriously enough as a passive investor. Once you invest, you have no other control. But that first part before you invest, you really need to take that seriously. Nowadays, things have changed in these last 1 to 2 years, with the rapid rise in interest rates and variable loan structures that many sponsors, good sponsors, had to do when they were enacting this sort of value add proposition where people would, basically buy an apartment, try to fix it up a little bit, increase the operating income, and then sell it. I mean, everyone was doing that, but the problem is that now deals are in more trouble. So I think, to get into some of the specifics, I think one of the things I would say is that you really have to pay attention to the debt structure of a deal these days. But the big picture, I think you need to, in general, need to pay attention to some of the due diligence.
Yeah, no, that makes sense. And on this topic of risk, and obviously I understand, the debt side, there's some inherent risk there. On the operator side, they're not all created equal, in the landscape. They all have different kind of backgrounds in terms of what they've, done. They're surrounded by different teams, that sort of thing. How does, or maybe does not, passiveadvantage.com help investors objectively assess risk in syndication deals?
Yeah, and that's a great way to put it, Jeremy. Like, we specifically differentiate ourselves in that although we have robust tools that help limited partners make these decisions for themselves, it's not really to tell you to invest or not to invest. But what you said is exactly right. Like, our goal is to point out some of the risk parameters or the risk points of the deal that you could then decide, depending on your own individual risk tolerance, do I want to invest in this deal or not? So when we with the at the inception of Passive Advantage, we, like I said, we started an Excel sheet where investors would have to manually go in there and, change the parameters themselves through drop down menus and things like that. So although it allowed them to not miss anything important because it was all sort of listed out and you could see, and then it still gave scores similar to what we do today, but it still took time. And we get these investment summaries, they're 50, 55 pages, and everyone's created a little bit different in terms of how they're structured and where things are located, so you're trying to peel through it and look through what's going on. So although we grew to probably 1,500 investors just with the Excel version, we kept hearing from investors that we want something that's less manual. So we then decided to pivot, and although it was a huge undertaking, to build out a software where now, with the new Passive Advantage or Limited Partner Deal Analyzer app, an investor literally takes that investment summary that a sponsor gives them, drops it into our sort of drop down screen, and then it populates close to 70 to 80% of those parameters for them. Now they still have to cross check it and things like that, but it uses AI based on the zip code to get all the sort of market metrics. Like we don't go as in depth as like CoStar and programs like that, but in terms of like the big things like the population growth, the job growth, the school ratings, the crime ratings, with the old version, you would have to search all that stuff out and find it yourself and dig through these pages. Whereas now we're able to, we basically created our own AI agent that knows which AI programs of all the different ones, the Perplexity and all these different AI programs, works best with each question. So and then within seconds you have the scores for the crime rating and all those variables. So yeah, so we're really proud of having this to offer it to passive investors to say, listen, listen, I'm a busy doc. I have 3 kids. I've been blessed with a wife. I have other things to do with my time where I don't need to spend the 2 hours on the investment summary trying to find all these variables. Now I could just plug it in, and within a minute, I have all those things mostly filled out. Now you still have to cross check, and it still is AI, but it saves a huge deal of time and allows investors to see some of these obvious risk points in the deal.
Yeah, it's incredible where technology and the AI space has taken us today. To the point in which, like you said, rather than me sitting down on a Saturday morning for 2 hours with a cup of coffee, to read through an offering memorandum, right?
Yeah,
I can leverage the tools of technology and AI to really come to the same conclusion in a matter of minutes.
yeah.
Um, would love to maybe kind of get your perspective on some key metrics that are out there that passive investors should really prioritize when vetting a deal or a sponsor. Are there 2 or 3 different metrics that kind of stand out to you the most, that you would say the passive investor should understand and know before they ultimately sign the subscription documents and send in their wire?
Yeah, that's a great question, Jeremy. And we've sort of narrowed it down to like 120 different points in our app, to where, obviously not, and we assign points to each of these questions, so not all of them are created equal. But that's the beauty of using the AI, is that you can kind of put it into this mixing pot and kind of get the scores and see all those variables. But to answer your question, if I had to, boil it down, now, the tricky part is there's a little bit of recency bias in terms of, for any people that are listening that are other passive investors, I don't have to tell them that, the last year or so, the year or two, with the rapid rise in interest rates, the debt structure has become more and more to the forefront. Whereas years ago, if there was a rate cap, then I wasn't necessarily dinging sponsors if they had bridge debt, just because that's the way you don't have to pay a large prepayment penalty. You don't have to worry about that up front. So you have to use, as a sponsor, you have to use that equation, like, do I want fixed rate debt but a large prepay, which kind of fixes, locks me in, or do I want some bridge debt that gives me some flexibility as long as I have a proper rate cap? But what was difficult to sort of ascertain is what that rate cap would cost as time went on, and that those costs on the rate cap were not necessarily locked in. So nowadays, the way our app works, and this is sort of a moving target, and we adjust these variables all the time. We really do in this market like to see fixed rate debt. Now, you could argue where we're at, it may make even more sense than before that bridge debt product is probably better. But it's just so many people are so afraid of that right now that if you're a sponsor trying to raise money, it's going to be really hard unless you have really loyal investors to raise money with bridge debt right now. So maybe you do a 5-year fixed or something like that. So I think the first variable to look at very closely in terms of all the variables that are associated with it is the debt structure of the deal and whether it matches the business plan. And I'm happy to give you maybe one or two more if you'd like to, unless you have a question about that.
Yeah, no, please do. And I think you're exactly spot on. I mean, the type of debt structure needs to match up, with obviously the business plan and, certainly the sponsor, if it's a value add, for example, well, they better, renovate these units on time and on budget. They better have plenty of reserves built into their model in order to be able to extend, that rate cap an additional 2 years if needed. And then, of course, there's a lot of sponsors in the space today, that are really just trying to outlast the market, right? We're trying to see where interest rates are headed. Everybody thought they were coming down in 2025, but instead they went in the opposite direction of where the Federal Reserve Bank, started signaling where rates were going to be. So it's an interesting time in the commercial real estate space for sure. And I can only imagine that your, solution is helping people. But I would love to hear maybe one or two additional kind of key metrics that you like to highlight.
Yeah, no, I appreciate it. And I think the tough part right now, especially in the multifamily space, I mean, obviously, I have other passive investments in industrial and self storage and mobile home and triple net lease. So I've sort of diversified across different, but in particular in the multifamily space, the difficulty right now is the negative leverage. So meaning that it's very difficult to in general the way we used to project the exit cap is it used to be sort of like a 0.1 percentage point from each year of the hold. So if it's a projected 5-year hold and you want to sort of then project the exit cap to be like zero point 0.5 higher than what the entry cap is. But where interest rates are these days, you oftentimes have negative leverage. So to me, that's one of the biggest difficulties of getting deals to pencil right now. Because unless sponsors project the exit cap to be less than the entry cap, which a lot of them are doing, it really is difficult to make deals work, especially with the sort of leverage requirements and amount of equity you need to bring. So as a sponsor, it's not easy right now to make deals work. And so I think the other big variable is looking at the entry cap and exit cap. And if there's not a gap there, meaning that the exit cap is higher than the entry, and you also look at the interest rate of what the interest rate is compared to what your cap projections are, it's going to be a higher risk deal. Now, could it work? Do I think interest rates will come down in the next 12 to 18 months? Yeah, I do. And so it probably could work, but a lot of LPs are gun shy right now, and it's just hard to take on that risk. So I think that negative leverage scenario that we're in right now would be number two in terms of one of the biggest things to look at when you're looking at that interest rate to cap rate situation.
I'm Zach Captainstall, CEO and co-founder of Rise 48 Equity. Our goal is to help you protect and grow your wealth by investing in large multifamily apartment buildings. We do all the work as far as sourcing these large apartment buildings from the brokers, doing all of the on-site management with our vertically integrated property management company, doing all the renovations with our vertically integrated construction company. We completely rebrand the exteriors. We will renovate the interiors to our full platinum level scope, which increases the value of the asset to get that profit margin for the investors. If you'd like to learn about how you can partner with us on these exciting opportunities, and go to our website and set up a call with our team.
Yeah, I had the wonderful Neil Bawa on as a guest a few episodes ago,
He's
and
great. He's great with the numbers.
he said one of the biggest challenges that he sees right now in the passive investing space is too many people are making decisions right now based upon the past 24 months when they need to start making decisions based upon the next 24 months. And
Right.
so, Neil is confident in saying that he feels confident that we're at or near a bottom right now in the current, real estate, cycle, which,
Yeah.
as we know, the peak was largely hit in the back half of 2021 or early 2022. And cycles in real estate typically last on average about 5 years. So that would lead you to believe that by, 2026, 2027, we're going to be in a better spot than we are today. Obviously, no crystal balls here, but when you talk about things like, the supply and demand imbalance and absorption rates and new product coming online and where people anticipate interest rates to be in the future, where we expect inflation, to be in the future, which is important to assess as well, because inflation
Absolutely.
largely drives interest rates, right? So, all these things are important, factors for people to consider. But just curious if you had any additional thoughts on that.
Yeah, no, I think you're spot on. I think all things, sort of all the fundamentals are there for multifamily and for real estate investing in general. I mean, listen, a ton of people have made a lot of money for years on real estate investing, so it's not something I'm just going to give up now. But I do think, and this is something that I don't hear a lot of people talking about, and I feel like people are underestimating the significance of this, only because I kind of sit on both sides, and that I'm not a sponsor. We don't raise capital, but I really have. We now have grown to over 4,000 limited partners on our platform. So I get the questions. I get the sort of pulse all the time of where limited partners are. And I think these last couple years, with some of the capital calls and the pause distributions, and even not in multifamily and ATM funds and other things, like limited partners have been hit pretty hard. And I think there needs. I don't think when the although the multifamily fundamentals and all the things you said are 100% spot on. I think people are like jaded a little bit, especially the limited partners, and I think they're not just going to come back. Like, I think there's going to be like since the 2012 Jobs Act, and this all started. This is our first real challenge. Like, that was after 2008. So, like, people just assume that limited partners are just going to come back in droves. Like, that's going to take time. And this is where, like, this, it's sort of serendipitous that we feel something like our limited partner deal analyzer app, because ultimately we envision a marketplace where sponsors can place their deals in a transparent way, similar to what comes up with the sort of results of our app. And that builds up a little bit of a trust with the limited partners to say, listen, we're willing to give up this information, because normally you don't always know the fees from the investment summaries. You don't always know the co-invest. You don't always know. You can't always make sense what the splits are. All this stuff with our app is up front. So we look at ourselves as a bridge that this space will probably need. And I know that's a bold statement, but I feel like the sponsors don't realize how much limited partners have been hit. I mean, they do, in a sense that you talk to any sponsor and they'll say they're raising maybe a third, if the good ones, maybe a third of the capital they raised 2 years ago. Some of them it's like an eighth. So they realize there's an issue here, but their assumption is that it's just limited partners are going to come back. But I think there needs to be a bridge between the two sides, where it's a little bit of the limited partners have a little more transparency to give them some confidence to get back in. And then the sponsors are saying, well, if this platform, but even though I'm kind of having to show myself a little more, if this platform has 5, 10,000 investors, then it's worthwhile to do that, because capital raising right now is so difficult. So we're hoping to kind of help facilitate that. But I do feel like there's a divide there that's being underestimated a little bit, in that I don't think it's just going to be like turning the light back on when those dynamics change. Although I agree 100% with you that the fundamentals are there. I just think it's going to sort of push over if we don't have some change in the way things are run between limited partners and sponsors.
Yeah, I totally agree with you. And I think the biggest difference there is the level of sophistication of the limited partner. I know the more sophisticated limited partner investors out there understand things like real estate, market swings, right? They understand, challenges with debt service and deals. They understand, supply demand imbalances. They understand that to properly invest in real estate, you've got to have diversification and dollar cost averaging on the mind, right?
Yep.
Not every deal is going to be a home run, right? Some deals are going to be base hits, and some deals you might, in fact, actually lose money, right? But that's why it's prudent for investors, not to stick all their eggs in one basket, to diversify over, maybe multiple different operators, multiple different, asset classes. And that's why, I think passiveadvantage.com, is a great tool to enable, people to achieve a higher level of sophistication using, technology and AI that they might not otherwise have.
Yeah, you're 100% right, Jeremy. And I agree with you. And I feel the same way. Like, I'm looking at it like when 2020, everyone's a prognosticator, and I'm sure I'll get it wrong, but sometime in mid 2026 or 20 early 2026, I mean, I think there's opportunities now, but especially as time goes on and when we start to see interest rates coming on, it'll be a huge opportunity. And we're trying to ready the passive investor now to be familiar with the platform, to be familiar with the terms and the key variables, some of which we already discussed. Because as much as we look at ourselves as being, the key word is sort of transparency, in terms of limited partners being able to see what's going on within the interworks of a deal, make it a little more approachable to where they're not having to figure all this stuff out themselves. We also see ourselves as an educator. Like we have webinars monthly where we go through each of these different sort of key concepts or key big structures. um, in terms of, we have a whole webinar on debt structure, a whole webinar on capital calls. So we feel like we use this sort of infrastructure of the app and how things are broken down to then teach, like, why is this particular metric important? Why do we really need to know about this? Because ultimately, listen, if we're spending $500, then maybe we're not going to spend on an investment. Maybe we're not going to spend as much time. But some of these are $50,000, $100,000 minimums. Like, the least you think how many man hours you've worked to achieve that. The least you could do is dedicate yourself some time so that you're going in with eyes open, and then you can decide, do I want to invest in this deal or not? I mean, I think that's the biggest message, is that we need to sort of improve the transparency and focus on that due diligence for the passive investors. And I think they realize that unfortunately a lot of people have been burned over these last 1 to 2 years.
Yeah, I agree, and I really appreciate your advice on something here, and I know that you don't have necessarily a dog in this fight because the limited partner is not signing your subscription documents. Okay, so my question here for you, and I trust your opinion in this regard. What advice would you give then to that high income professional looking to start investing passively in real estate for the first time?
Yeah, that's a great question. And I would say that investing in real estate is still a great opportunity, and it's a great investment. I know it's difficult to envision that in the sort of at the point at which we are in the market and we are in the cycle at the moment, but ultimately, like, when you do, like, when you do sort of all the calculations, like the quote Jim from White Coat Investor, sort of the 4% rule and 25 times your annual expenses, or, you know, you look at the amount of time in a career that it takes to achieve that goal. That may take 25 or 30 years to where you would have sort of the classic route to the traditional retirement. But who wants that? Like, I'm blessed to have the ability to just cut down to 4 days a week. So now I have Fridays off to spend with my family, to do some real estate stuff. I could do whatever it is that I choose to do, and investing in real estate has allowed me to do that because it takes a chunk off of that income now that I'm required to save to get to that point. So for every, if you assume the 4% rule and you need, $40,000 per million saved, and you need, say, 120,000, then you got to save 3 million to get to that point. Whereas with real estate investing and establishing some passive income, if I can get the passive income coming in from the real estate, then that cuts off whatever that requirement is for me to save, and it allows me to achieve some flexibility a lot early. So I would say the one thing is don't underestimate, even though it's difficult in this time, to the first time investor, the value of real estate investing. Ultimately, I'd say that's sort of the first thing, and then the second thing is just take the due diligence serious. And I know it can be daunting, like when you're hearing these terms, and some people don't know what the exit cap rate is, and even though it's familiar to you and I, like, so we're trying to make this due diligence process so much more approachable. Like that's really our mission, because I want other people to be able to do what I'm doing, and take a day less. I mean, it's not, the days of working seven days a week and killing yourself as a physician, like you got to take time. Like life's too short, and not to get philosophical, but those things are important. And the fact that I've been able to do that for myself, it gives me joy. It allows me to spend time. I have 3 young kids under the age of 9. Spend time while I don't get that time back. It's hugely important, and I think it's not something to underestimate when you're thinking about making that first passive investment.
Yeah, I appreciate your perspective there. And I'd love to get, personal with you now. And the question is really, how is it that outside of your real estate investments that you've made and kind of replacing, some of the dependents, on the W-2, how do you balance your career as a physician with your role as an investor, an entrepreneur, a dad of 3, those types of things?
I'm still trying to figure that one out. It's a constant balancing act, and I love what I do as a physician, and even if I tell people all the time, even if I won the lottery, I would still do what I do as a physician. Maybe I'd cut down one more day a week, but I would still do what I do because I really do enjoy helping people. I feel like being a physician is my calling, and I'm not looking to stop that. But I feel but the entrepreneurial pursuit is unique in that it sort of taps into a different part of my brain than I do as a physician. Whereas I've been doing, I do procedures, so I've been doing them so long, and it's not as if things don't come up, but you're used to seeing different things and unique things, and it doesn't phase you anymore. Whereas as an entrepreneur, it's a whole different world in terms of social media. Like this is coming from a guy who never had a Facebook account. Like I'm an old school Italian guy, but that liked real estate investing, but I've had to kind of figure out some of the social media stuff and things like that, and try to be as present as I can with it and help people. But to answer your question, I think it's a continual moving target, and each day I'm just thankful to have, and I try to make sure I allot time. And with each of my kids, like we have like a little date night with my daughter, and I take my sons out to do some go-kart racing and stuff like that. Like I really feel like it's important to have specific goals with your time, and plot it out ahead of time so that it does, otherwise everything will kind of blend into one another, and you won't feel as fulfilled when you sort
Right.
of allot different time.
Yeah, that's right. I know that to be true in my own life. And you just really need to be, you need to prioritize and you need to be intentional about those times and not allowing other things to interfere, with that time. So, outside of just going over to passiveadvantage.com and, checking out the site, what would be maybe one or two other ways that our listening audience can connect with you to learn more about what you're up to?
Yeah, I appreciate that, Jeremy. I mean, people can email me directly. My email is sam@passiveadvantage.com if you have any specific questions or want to run anything by me, or even if it's not related to real estate, you just, you want to follow up to the conversation that we're having now. I'm happy to help any way I can or point you to different resources. We do have several other resources like on our site in terms of books and things like that. Like Brian Burke's book is great. Hands Off Investor is a great resource. We have a bunch of other resources there that we can point people in the direction of. And yeah, I would just head over to passiveadvantage.com. We have several free ebooks that we're offering to the audience right now. One is a 30-page capital call, how to evaluate a capital call ebook. So for those of us in the unfortunate situation that may be, faced with a capital call, like what sort of variables can you do and what can you ask the sponsor to make a better informed decision as to whether or not you want to participate. And then in addition, we are offering at the moment sort of 2 free deals that if somebody has an investment summary, even if it's not a new one, even if it's a deal that went bad, to see if there's anything that could have been seen early on, just take the investment summary and sign up and plop it in the app and see what happens. And it's I think that's the main thing. We're just trying to help people get the word out and improve the sort of knowledge base to the due diligence process for passive investors.
That's great. Well, I really appreciate, your time and the tremendous value that you've brought us today, Dr. Sam.
Thank you so much, Jeremy. I really appreciate it. And you don't have to call me doctor
How
anymore.
about Dr. G?
There you go. There you go. That's great.
All right. Well, thanks again. I appreciate it. And listening audience, thank you again for jumping into another episode of The Freedom Point. We look forward to having you join us on the next episode.
Thank you for hanging out with us today and for listening to the Freedom Point podcast, powered by Starting Point Capital. This show is for entertainment purposes only. Nothing said on this show should be considered financial advice. Before making any financial decision, please consult with a professional. This show is copyrighted by the Freedom Point podcast. Written permissions must be granted before syndication or rebroadcasting. If you're interested in connecting, you can find contact information at startingpointcapital.com.